What if I told you the IRS lets you write off a building without actually losing money on it? That's what I'm talking about today. Stick around. Hi, welcome back. My name's Joe Brown. I'm a real estate agent with Century 21 Lists with Beggins, located in South Tampa. Thank you so much for being here. So, as you might know, through my many videos, I do a lot with residential real estate. However, I am also a commercial specialist and a candidate for the CCIM designation. And so the next 2 weeks, this week and next week, my videos are going to be about tax saving strategies. And so today I just want to share a few ways for investors to save money on taxes. And I'll throw a graphic up here just so you can see the three ways I really want to talk about is number one, just cost recovery, also known as depreciation. We have the loan cost amortization. Then we also have cost desegregation. So let's just start with depreciation, right? So think about if you use a car for business, you get a car and you're able to depreciate the value of that car over time. Well, same thing with buildings. Now, with a commercial building, if it is used for residential purpose, so maybe you have single family homes that you rent out, or you own an apartment complex. Those are residential, and so the lifespan, the depreciation period, is 27 and a half years. Other commercial properties would be 39 years. And there's tables to use, mid-month calculation, all that. Talk to your CPA about that. But basically, you can depreciate a building over 39 years or 27 and a half if it's residential properties. So let's say you're renting a property. So you own the property and you lease it to a tenant. And then so you have the income coming in, you have the operating expenses. Then you have the net operating income, NOI. And typically, you would pay taxes on the NOI. However, you can depreciate the value of that building each year. So I did a calculation. So let's say it's a office building that costs $500,000. So each year you can deduct about $12,800. Did that $12,800 come out of your pocket? No. So again, you collected money, you had operating expenses, you have your net operating income, but from that net operating income, you can deduct the depreciation. It's not money you've lost. You're just reducing that NOI. $12,800 a year for 39 years. Got it? Now, it's not, listen, this is the government we're talking about, okay? And they want their money. So when you go to sell the building, so cost recovery and depreciation has two effects. One, it deducts your NOI for what you pay taxes on each year, but it also reduces your cost basis. So let's say you paid $500,000 for a building. Now there's costs associated with the purchase, so that lowers the cost basis. But each year you take depreciation, lowers the cost basis. So when you go to sell the building, your cost basis is lower, and then you have to pay tax on what you have depreciated over the course of holding, right? However long you held the property, 5 years, 10 years, 20 years, you have to pay a recapture tax on that, right? It's the government. They want their money. However, the recapture is going to be less than paying taxes over the life of that holding period. So that's depreciation. Now, I talked about when you purchase a property and you take a loan, getting a loan has cost. It can be a couple $100, it could be several $1,000s. Well, you can amortize the cost of that loan over the term of the loan. So this is where terms get sticky. I take a loan and I amortize it over 25 years, 30 years, right? That's the amortization period. However, the term of the loan may be 10 years. That means my monthly cost is based on paying it off in 25 years. However, I have to pay it off in 10 years. So I have my monthly payment come the 10th year, I have to pay the full thing off or refinance the loan, okay? So the cost of the loan can be amortized, right? That's hard to say. Over the term, not the amortization period, over the term, right? Now that reduces, again, your taxable income without actually taking money out of your pocket. And here's a third way you can save on taxes, and it's called cost desegregation. So think about this. You buy an office building, and what's in the office building? You have carpet. Maybe you have furniture. You have different items that really are not going to last 39 years. So you can hire, it's a CPA, accountant. There are special companies that specialize in cost desegregation, and they come in and give a value to the items within the office, and you can depreciate those at a faster pace than the 39 years. In fact, you can depreciate all of that cost desegregation in the first year. And you can carry those, because if it ends up, so for example, if your gains, your net profit that you are taxed on, let's say is $20,000, but the cost desegregation reduces, or is, you can depreciate, let's say $40,000, but you can only depreciate what you've earned. You've earned 20, you can depreciate 40, so that wipes out the profit of 20. Then you have 20,000 you can apply either to other passive income or carry forward to the next tax year, right? So this is a quick video, right? I want to give a broad overview of 3 tax-saving benefits for investors. So I'll throw the graphic back up here. You have depreciation of the building. So it's either 39 years for commercial buildings or 27 and a half years for residential properties, whether it's single-family homes, duplex, quadplex, apartment buildings, 27 and a half years. There's the loan cost amortization over the term of the loan. And then there's cost depreciation for the items within the building that really don't have a life of 27 and a half or 39 years. Now, next week, I'm going to go into one other tax saving strategies that really can build generational wealth. So you want to be sure to check back next week. Listen, if you have any questions about this, go to my website, my commercial website, joebrown-commercial.c21.com. Contact me button. You can see my listings that are out there. Feel free to send me an email, call me, whatever. For more technical analysis, you really want to talk to your CPA and financial advisor. Okay? Anyway, thank you for watching this. I hope I didn't talk too fast. Until next week, take care.